We learn about maybe how doing less could help you earn more at times. We'll talk about the world of passive investing.
Generally, it is meant for investing in indices, okay, or index, okay, and those index could be of different kinds. You could have a Sensex or a Nifty. The world of passive investing has become very, very large globally in the last 25 years. Vanguard started offering those passive funds at a very low cost, And so if an active fund was charging 2% at that time, Vanguard started charging maybe 0.3, 0.4. And that difference of 1.5, 1.6% grew over a period of time. From there, just one fund, passive investing is now become $1 trillion, trillions of dollars.
As far as we know, there are more than 316 index funds and more than 250 ETFs now in India. Does it create confusion for the investors? How do they differentiate between the availability right now?
The industry size is, I think, around 3 lakh crore or so. And but the biggest contributor in this 3 lakh crore are the institutional investors.
What are they seeing in the passive markets that the others are not able to see? Maybe the retail audience is not able to see.
The fear that active managers may underperform. Okay, so that's one of the bigger concerns.
You also run funds within Ladderup Asset Managers. Do you think active management in India is still?
Any sane investor would have wanted to stay away from Zee Telefilm because the entertainment, because of the issues that the company was going through. I may not have a great view around TCS and Infosys, in the view of artificial intelligence. But these are the two biggest stocks in the index. I just happen to know it because my team analyzed it a week before. We looked at last 10 years of data, and except for 1 year, in every single year, more than 50% active managers beat their benchmark. One of the biggest growth areas globally, and not for 1 or 2 years, it will remain so for next 10, 20, 30 years. This company is in where they have created an ETF, which is investing in the EV ecosystem.
Okay.
So batteries, software, tire manufacturers. EV cars have special tires. In last 14 years, S&P 500 has grown around 7 times.
So now what is your view? I know you're a proponent of active investing specifically, but what is your view for any investor who wants to start their journey with passive funds, and for investors who are already entrenched in the active investing world and want to maybe try a passive fund? Where should they look at? Hello everyone, and welcome to another episode of Beyond Just Returns. I'm your host Upasana Koul, and I have with me the Managing Director of Ladderup Asset Managers, Mr. Raghvendra Nath. And today we are here to discuss a very hot topic. We learn about maybe how doing less could help you earn more at times. We'll talk about the world of passive investing. Welcome on this conversation.
Yeah, thank you. Thank you, Upasana.
So let's dive deep into it. Let's start with understanding what passive funds are. If you could tell our audience about what these funds are, how are they different from actively managed funds? Let's start from there.
So when we say passive, these are funds where there is the intervention of a fund manager is not there, and that's why the word passive. That a fund manager is taking money and then investing into something, and where he doesn't have a choice of investing how much and where. And that's why the word passive. Generally, it is meant for investing in indices, okay, or index, okay, and those index could be of different kinds. You could have a Sensex or a Nifty, which are the more popular ones in India, or you could have a bank Nifty, or you could have a small cap index. And so the world of passive investing has become very, very large globally in the last 25 years. In fact, the first fund in the world to kind of bring in this concept of passive investing was Vanguard. And they started this passive investing because they said that rather than paying hefty salaries to fund managers and who come and invest into X stock and Y sector, and many times basically they are not even able to beat the index. Why not invest in the index itself? And index itself is like index has enough and more stocks. And generally, when you look at large cap indices, let's say a Dow Jones or an S&P 500, in India it's Sensex and Nifty. These are some of the best known companies of the country, and the biggest companies of the country. So how wrong can you go by investing into 30 or 50 best known companies of the country? Okay, so
Right.
that was the thought. And because there was no fund manager and no hefty salary, Vanguard started offering those passive funds at a very low cost. And so, if an active fund was charging 2% at that time, Vanguard started charging maybe 0.3, 0.4. And that difference of 1.5, 1.6% grew over a period of time.
Interesting.
Okay. And so from there, just one fund, passive investing is now become $1 trillion, trillions of dollars, not 1 trillion, trillions of dollars industry actually.
Wonderful. So, as far as we understand, we have index mutual funds and we have ETFs. But as you mentioned, both fall under passive category and both track indices. So, what's the difference between these two?
So ETF is exchange traded funds, which means that somebody creates a fund, issues the units, and then list those units on the exchange. And like a share, you can buy or sell units at the price at which it is quoting. And because the indices are moving up and down whole day, the value of those ETFs also keep changing in line with the index which they represent. And therefore, you can actually participate even in the day-to-day volatility of the market through the ETFs. Whereas index funds are generally launched by mutual funds in an open-ended environment, but they follow the same principles of NAV calculation and everything like an active fund, which is that there is a cutoff time. The NAV which was on at the cutoff time is what is allocated to all the investors. So whether you invested in the index fund at 10 o'clock or 3 o'clock, both the investors will get the same NAV, which is the end of the day NAV.
Okay.
Whereas if you invested in ETF, a 10 o'clock investor will get a different price than a 3 o'clock investor.
Fair. Understood. But as far as we know, there are more than 316 index funds and more than 250 ETFs now in India. Does it create confusion for the investors? How do they differentiate between the availability right now?
So conceptually, both are same. Whether you are investing in ETF or you are investing in index fund, you are basically following the concept of passive investing. So it doesn't matter. Generally, because in ETF, there is no distributor involved. There is no wealth manager involved. There is no bank involved. And so you need to basically therefore select the ETF yourself. So people who are investing in equity markets regularly, they have a broking account, they have a demat account, they may be more comfortable buying ETFs.
Okay.
But let's say if I don't have a broking or a demat account and I don't know what ETF is or what index fund is, but I want to invest passively. So I go to a distributor.
Okay.
Now, if a distributor is offering advice, he would also want some income, and that's where they recommend index funds instead of ETFs. Because the client, when he buys an index fund, whatever may be the expense ratio of the fund, a portion of that will go to that distributor or wealth manager or bank by way of commission. So he earns a little bit of money.
Fair.
So, and that's the reason why index funds and the ETFs both are growing parallelly. If you are seeking advice from an advisor, he'll generally suggest you index funds because he can earn a small income out of it. And if you are on your own, you will generally go and buy ETF because it's more convenient to buy.
Got it. You're right. In terms of index funds, the assets have grown by almost 30 times over the past 5 years. But a majority of this is also contributed by institutions.
That's right.
So what do you want to tell us about the composition of the investor base?
Yeah, so I think right now the industry size is, I think, around 3 lakh crore
Correct.
or so. And but the biggest contributor in this 3 lakh crore are the institutional investors. So if you remember, around I think 5 or 7 years back, the government said that okay, EPF can also invest into equities because EPFO, which is Employee Provident Fund Organization, all the salaries generally, portion of that go into Provident Fund,
Correct.
and EPFO manages that. And EPFO declares a fixed rate of interest, which is around 8%. I think it's now 7.75 or something every year. So it has to earn 7.75, and it's becoming increasingly difficult for EPFO to earn that 7.75 through fixed income because interest rates have come down. 20 years back, Government of India securities were trading at 10% per annum. But if you buy a 10-year government security, today the same government security gives you 6.6%. So if EPFO invests only in government securities, it can't give you 7.75. It can only give 6.6 minus its expenses.
True.
Okay. So if it has to give you that 7.75, it needs to invest into assets which can earn a little more. So the government said that, okay, let's play it safe. Otherwise, the size would have been maybe 10 times bigger. So they just played it safe. So whatever is the incremental flows, 15% of that is now getting invested in markets.
Got it.
And because government doesn't want EPFO to go wrong horribly because it's public's money, and EPFO itself doesn't want to go horribly wrong, they are investing only in index funds. So which is Nifty and Sensex or whatever. So this, because every month EPFO collects Provident Fund contributions from employees and employers, 15% of that religiously goes into the market. So EPFO is doing an SIP on your behalf, actually, in a way. Sure. And that's how that has grown. And same is with NPS, the new pension scheme, which was launched around 15, 18 years back. So when you choose the equity option in that NPS, that money goes into index funds.
Understood.
So those two institutions are the biggest contributors. And the retail and HNIs, obviously HNIs are also investing and all that, but it is yet to catch on in India in a meaningful manner.
Fair. So although HNI contribution is increasing, it's now at around 14%, which was maybe around 2% 5 years ago. But are these HNIs seeing something differently as compared to others? Although the contribution is still small, but what are they seeing in the passive markets that the others are not able to see? Maybe the retail audience is not able to see yet.
So there's this talk now, or noise around expense. Some of it is, I agree also, is correct. Okay. So when you buy an actively managed fund, the expense ratio can be anywhere from 1.5% to 2%, depending on the size. And then you're hoping that this active manager will beat the index. In the index fund, the same expense could be 0.5% or even lesser. So this difference, which is 1.5%, people start calculating that over a long period of time and say that, okay, 1.5% every year over next 20 years will mean 40-50%. Okay, compounding effect. So why basically paid so much money? And so more evolved investors are now looking at index investing as part of their portfolio.
Okay.
But I think still I have rarely come across investors who are purely in index funds. So they may have an equity portfolio, they may have a mutual fund, actively managed mutual fund portfolio, some PMSs, and they may have a few index funds as well.
Sure. So how you did mention about the cost component of it, and ETFs go as low as 0.4% also at times. Is it primarily because of cost being the factor that the investors are attracted to it, or is there any other thing also that it is a part of the portfolio?
So one is obviously the big component is cost, and the fear that active managers may underperform. Okay, so that's one of the bigger concerns, and the proponents of passive investing, that's what they keep talking about, that half the managers are not going to outperform, and that's
Right.
what data, especially globally, when you look at that data suggests that. So why take a risk if you invested in a fund and that fund underperformed? Then the whole idea of active investing is lost. So why take that chance? Invest in the index fund. At least you will earn that much, whatever the market is. And in the long term, if you are trying to compound wealth through equity, rather than figuring out X stock, Y stock, or X fund or Y fund, you just pick up one index fund and your life is sorted.
Right.
So for people who don't have active management, or let's say who don't have wealth managers who are managing on their own, it becomes much easier for them to participate in markets by investing into indices.
Got it. But is there a counter argument? Do you think that you also run funds within Ladderup Asset Managers? Do you think active management in India is still something that
It is. I though ardently believe in it. In fact, my logic stems from three things. Okay, one is uh, about the way the indices are constituted. Now, like for instance, Z Enterprises was part of index just 3 or 4 years back. Okay, and when it was going through all these issues, the SL group had defaulted on debt obligations, and then there was this fight which was going on between Z and Sony, and so a lot of water has flown under the bridge. Okay, so any sane investor would have wanted to stay away from Z Telefilm, because Z Entertainment, because of the issues that the company was going through. But if I invest into an index fund, I get a portion of that Z in my portfolio.
correct?
Okay, let's say I have a negative view on real estate. Let's say there's massive oversupply in real estate. Okay, right now, and I see that. I'm not saying there real estate is actually quite positive right now, but let's say if it was, I will end up owning all the real estate companies which are part of the index. If I have a negative view on IT or negative view on metal, I don't have a choice. Okay, so by nature, index is inefficient, because index is trying to give representation to all the sectors which matter in the economy. But I may not be bullish in all the sectors. In most economies, you will never find that all the sectors are doing well all the time. Okay, and so by doing active investing, I'm able to avoid things that I don't need. Okay, like I may not have a great view around TCS and Infosys, in the view of artificial intelligence. But these are the two biggest stocks in the index. And if I buy the index, then I end up owning those stocks, and not small quantities.
Correct.
18-19% of my portfolio will be invested into these two companies, where I may not have a great view. So active investing has a place in the portfolio. In fact, if you were to look at data, and I just happened to know it because my team analyzed it a week before. We looked at last 10 years of data, and except for 1 year, in every single year, more than 50% active managers beat their benchmark.
Okay.
So let's say they are right now around 450 funds. Let's say last year, 60% managers beat the benchmark, which is basically around 450, 60%, almost 300 odd fund managers beat the benchmark. So as long as the probability is more than 50%, it makes immense sense to invest into active funds. And more importantly, nobody buys one fund.
True.
So this logic that why take a chance on active, because what if the fund manager underperforms, is holds true only when I'm betting on one guy. If I'm investing with 10 guys, and let's say only 5 outperformed, Okay, and the other five is not that they'll lose 10% more than the index. They'll be near about, because at least every fund manager who's qualified will try to basically is trying to meet and beat.
Correct.
Okay, nobody is having a strategy to trail. Okay, so even if somebody trails, it will be by a few percentage points, which I think can more than be made up through the fund managers who have outperformed in that year.
Fair enough.
So and that's been our track record. In fact, we have been managing money now for 14 years, and we run a fully active strategy. And every single year, the portfolio that we have has beaten the benchmark every single year. So if by paying 1.5%, our clients are able to beat the benchmarks by 2, 3, 4%, then why not? So this logic of cost goes away if you have outperformance.
Fair enough. Talking about specific high conviction or low conviction sectors, there are certain passive funds which are focused on industries or sectors per se. What is your view on that? Are they a fair representation of what's going on in the economy and where you should focus?
Yeah, so in fact, one of the ways in which a lot of sophisticated investors have started using passive investing is when they have a specific view on a theme or a sector.
Okay.
Like cybersecurity is a very big theme globally. In fact, spamming, phishing, people are talking about WhatsApp being hacked. Cybersecurity is going to be one of the biggest growth areas globally, and not for 1 or 2 years. It will remain so for next 10, 20, 30 years.
Right.
Okay. Now, if I have to invest in cybersecurity, for instance, in India, I have not a single company listed on the exchange. So then what? If I want to participate in this theme, how do I do? So then, there are ETFs globally which are investing in cybersecurity companies all over the globe. So by just buying that ETF, you are able to invest into some of the most successful and largest companies in the field of cybersecurity. And not today. You can continue to remain invested in those companies for next 10, 15 years. And if a new company emerges and it becomes large, that you'll own that company as well. So there are, and there can be so many such themes. For instance, gaming is a big theme. Electronic gaming. Everybody, right from a 70-year-old to a 7-year-old, is on phones and doing gaming. Now, how do you participate in gaming? There's in some of the best known companies. So again, ETFs can be so they are these vehicles in passive investing because of the wide range and because of the ease with which they can get created. Like I know in India, somebody has launched a EV ETF. So it's basically because electric vehicles are now becoming a big rage.
Correct.
And more people are going to adopt electric vehicles in future. This company is in where they have created an ETF which is investing in the EV ecosystem.
Okay.
So batteries, software, tire manufacturers, EV cars have special tires. So companies which are specializing in that, and the EV manufacturers themselves. This company is trying to. So because of the ease with which you can create these themes and ETFs, and then you can manage them, the number of choices in the passive investing will become more and more, and that's what has happened globally, and in India also it will happen gradually. And so for the most sophisticated investors, passive investing has a place in their portfolio.
Sure. So talking about the global counterparts, globally passive funds are much larger. Even some funds are larger than their active counterparts. What has happened there? Is it primarily the constitution of the index itself? And how is it different from what's happening in India?
So this is, so a very interesting question, Upasana. In fact, the whole revolution in passive investing has come about in the last 14, 15 years. And it's very interesting because So S&P 500 is the most watched and most traded index now in the world. Okay. So it has the 500 biggest companies of US,
Correct.
United States, as part of the index. Now, most indices are market cap weighted, which means that if a company has a market cap of 10 lakh crore, it will have 10 times more weightage in the index than a company which has 1 lakh crore of market cap. Okay. Now, today, if you were to buy S&P 500 today, just seven companies, which is now called the Magnificent Seven: Apple and Microsoft and Facebook, Netflix, Tesla. There are these seven
Correct.
companies and Alphabet. You will own 33% of your money will go into buying these seven.
Oh, okay.
And the 67% will go into buy the other 493.
Wow. Okay.
Today. For just 15 years back, so let's say 2009, and in 2009 this number was 5%.
Oh, okay.
Okay. So if you had invested 100 rupees in 2009 in S&P 500, 5% would have gone to these seven companies, and 95% would have gone to 1493. Okay, so in last 14 years, S&P 500 has grown around 7 times.
Okay.
And the weightage of these companies has gone from 5 to 33, so 6 times, let's say. Okay, so these companies have gone up 42 times.
Wow.
On an average.
Correct.
Okay, 42 times in the last 14 years. So what has happened is that, because when you are investing in index, today, when you are investing in index, this every 100 rupees, 33 is going into these companies. So the demand for these shares of these companies is far more than the other 493. So the price automatically goes up, because share price is nothing but demand and supply. Okay, and so the weightage of this companies in the index creeps up. Okay, now because it's crept up, whoever is investing in the index will buy more of these companies. So it has become a self-feeding loop. So 5% became 6, and 6 became 8, and 8 became 10, and 10 became 20. And every time it became higher, more money went into these companies. So the market cap basis has created this outperformance. So when people are saying that, active managers in US have not beaten the S&P 500, no active manager will invest, if they have a 500 stocks portfolio, will invest 6% into a single company. In index, you end up buying 5%, 6%. In India, the HDFC Bank has now, I think, 11 or 12% in the index. You check all the 450 funds in India, which are actively managed. None of them will have 12%. They'll have 4%, 5%, 6%. So because they are diversifying, they are reducing the risk. But somewhere the returns are not commensurate, because of the overall allocation to a few stocks.
Interesting. Got it. Now moving on to more thematic, or not even thematic, there are factor-based passive funds which have come in. Some funds which combine active and passive strategies both. What is your view on that, and how do you see that growing in the India market?
Yeah, so there are these niches, and I know what you're talking about, like these momentum index and all that, which are getting created. People keep experimenting with newer themes, and that's what I said, that it's very easy to create an index, and for the index managers also, it is fresh revenue stream, because index is created by an external agency.
Correct.
When I, as a fund house, when I track that index, I have to pay them a licensing fee. So by creating more indices, they actually shore up their revenues. So they have a commercial case to keep launching newer and newer models and indices. But these themes and all that is okay for a sophisticated investor. somebody who knows that, okay, market is in momentum, so it's better to buy a momentum index than to buy a Nifty 50 or Nifty 100 index. But these, because these themes cannot be long-term themes. You know,
True.
if you were to buy a momentum index for 5 years, it will only create more volatility. It may not create too much return. Okay. And if you are thinking long term, 10 years, 20 years, 30 years, and which you should be thinking when you are investing into equities, then broader indices are far better than these, kind of tactical indices.
Okay. Okay. So now, what is your view? I know you're a proponent of active investing specifically, but what is your view for any investor who wants to start their journey with passive funds, and for investors who are already entrenched in the active investing world and want to maybe try a passive fund? Where should they look at?
So, if you of course, if you are investing on your own and you don't have the time, you don't have the skills, and you don't have the information, but you are very clear that I want to continue to invest on my own, I don't want anybody's help, I think passive funds can be a large portion of your portfolio. Easier to manage, very clear. Instead of just betting on a manager randomly or picking up a fund which is newly launched, when you're investing in passive, it also brings a sense of discipline.
Okay.
And somewhere you can track those better. You invested at the Sensex of 60,000, the Sensex has become 80,000. You know that I've got a 33% return.
Fair.
For tracking an active index, you need to follow what the NAV of the fund is, and therefore it's more difficult. So there is a case for active passive investing into people where they who do not have help, and rather than relying on a very incompetent wealth manager or somebody who doesn't have the right intent. Okay, it's better to basically invest in passive funds. At least you're not losing money.
True.
You're making as much money as the index. And I think most investors should be worried about the scenario where advice creates losses. And it happens just too often in the marketplace, okay? And there are these all kind of people who are peddling their wares. Somebody is talking technical analysis, somebody is talking factor investing, somebody is talking something else, and they will show a short-term return that I have generated 50% return per annum, okay, last 2 years or 3 years, and people invest, So the risk of loss by improper investing is far higher. And so if you want to avoid that, and you don't have good quality help available or advice available, it's better to invest in index funds. At least your money is safe. At least you know that if index goes up by 13%, I'll also grow by 13%. Last 40 years, index has produced 800 times returns. Which other asset has produced? So if the index produces 800 times next 40 years, I think people will be very happy. So they don't need to do anything funny. So there is a good case for passive investing. But if you are even for investors, as I mentioned, we also invest in passive funds. Just recently we invested in pharma, because we had a positive view on the pharma sector. Our model suggested that. So we invested in one active fund and we picked up one ETF.
Okay.
In fact, in last 4 months, that ETF has done better than the index fund. The active fund.
Active.
So at least we averaged out. So there is a place, I think, even if you have a large portfolio of active funds, you can have a sprinkling of passive funds, either through these thematic investments which you are excited about, or even broad-based.
Understood. Perfect. What is the role of advisors here? Are advisors genuinely suggesting for passive funds to be a part of the portfolio?
They may not actually, and the reason is simple that their income is a function of the expense ratio. Okay, if the expense ratio of the fund is 50 paisa, they'll get a small portion of that.
True.
Okay. If the expense ratio is 1.5%, they'll get a small portion of that. But the small portion of 1.5 is bigger than what small portion of 0.5%. So their model is not aligned.
Okay.
And in today in India, this advisory businesses have not taken off much. Okay, even though SEBI has wanted that advisory should become a larger portion than the distribution, it has not happened, and for a variety of reasons. So distributors are still a little, but I think somewhere distributors are now realizing that because investors themselves are asking for index funds. Some portion of their money is actually now getting into, and people advise, they are actively advising. In fact, and that's the reason why you see that 10,000 crore becoming 40,000 crore for HNIs will be thanks to the distribution community.
Interesting. Fair enough. Now, closing this session, what is your final verdict? Active or passive?
I am so big votary of active, as I mentioned to you, and the outcomes have bore that out. I think for the next 5-10 years in India, especially, active will continue to be ahead of passive.
Okay.
And because the nature of the markets are like that, we are still evolving. The market is in a growth phase. India itself is in a high growth phase. And when you are growing at 10, 11, 12% at the broader economy level, it's not very difficult to find choices which are growing at 14, 15, 16%.
Right.
Index will have the companies which are growing at 15 and the companies which are growing at 5. So it's easier for the active managers to avoid those 5 or companies which are growing at 5, 6, 7%. And therefore, most managers will actually end up beating the market. And when I was mentioning this data about yearly, if I were to just look at that data on a 5-year basis, let's say, the results will be 80-85% of the managers have beaten the market.
Fair.
Okay, so, and I'm not investing for 1 year. I'm investing for 5 years, 7 years, 10 years. So the probability that the active manager that I have chosen will beat passive funds is pretty high in India. And especially when you are with a good wealth manager.
Perfect. So this was a promising closing note. All votes for active with some sprinkle of passive, definitely. Thank you so much for this interesting conversation.
Thank you, Upasana.
And for our audience, thank you so much for joining us. Do comment and tell us what you liked about this episode, what you would like to know more about. We'll be happy to share that as well with you in the future. Thank you so much for tuning in to us.